The global economy is beginning to shake as war tensions in the Middle East push oil markets into a new period of uncertainty. Across financial markets, traders, economists, and governments are watching the same indicator more closely than almost anything else right now: the price of crude oil. Over the past several days, oil prices have surged sharply as tensions involving Iran and regional military forces continue to escalate. For energy markets, conflict in the Middle East has always carried enormous consequences. The region contains some of the largest oil reserves on Earth, and the shipping routes that move this oil to global markets are among the most strategically important corridors in the world. When tensions rise in this region, energy markets react almost instantly. Traders begin pricing in risk. Shipping companies worry about supply disruptions. Investors move money rapidly between commodities, stocks, and safe haven assets. And that is exactly what is happening now. Crude oil prices have jumped significantly as fears grow that the conflict could disrupt supply. The possibility of attacks on energy infrastructure, shipping lanes, or export facilities has created a wave of uncertainty across global markets. Even the possibility of disruption can push prices upward because energy markets depend heavily on stability. A sudden shortage of supply can have cascading effects throughout the global economy. And when supply routes run through active conflict zones, markets react quickly. To understand why this matters so much, it helps to look at how oil prices influence the broader economy. Oil is not just another commodity. It is the energy source that powers transportation systems, industrial production, and global trade networks. When oil prices rise sharply, the cost of moving goods around the world increases. Airlines pay more for fuel. Shipping companies face higher operational costs. Manufacturers spend more to power their factories. These costs eventually reach consumers. Food prices can rise, transportation costs increase, inflation begins to climb. That is why economists pay such close attention to oil markets during periods of geopolitical tension. Right now, markets are responding to several interconnected risks. The first risk involves the possibility of supply disruptions from major oil-producing countries. Iran itself is a significant energy producer, but the broader concern involves the region surrounding the Persian Gulf. Countries like Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates export millions of barrels of oil every day. Much of that oil travels through narrow maritime choke points. If those routes are threatened, global supply can tighten rapidly. The second risk involves shipping security. Oil tankers move through key corridors such as the Strait of Hormuz. Any threat to commercial shipping can disrupt the steady flow of energy supplies. Insurance costs for tankers can spike dramatically during conflict. Some vessels may even avoid the region entirely. Even a small reduction in tanker traffic can push prices higher. The third risk involves speculation and financial market behavior. Commodity traders often respond quickly to geopolitical developments. When conflict appears likely to escalate, traders buy oil futures contracts. This increases demand in financial markets, pushing prices upward. That surge in futures trading can amplify the impact of geopolitical news. In recent days, global stock markets have also reacted to rising oil prices. Investors tend to become cautious during geopolitical crises. Higher energy costs can slow economic growth. Companies that depend on transportation and manufacturing often face higher expenses. As a result, stock markets sometimes experience increased volatility. We are already seeing signs of that pattern. Major stock indices have shown fluctuations as energy prices rise and geopolitical tensions increase. Energy companies sometimes benefit from higher oil prices, but other sectors may struggle under the weight of rising costs. Technology stocks, transportation companies, and manufacturing firms can all feel the pressure. This creates an environment of uncertainty in financial markets. Investors begin shifting money toward assets they believe are safer. Gold often rises during these periods. Government bonds can attract investors seeking stability. Meanwhile, riskier assets may experience sudden declines. Economists are also watching another important factor: inflation. Higher oil prices can contribute directly to rising inflation rates. When fuel costs increase, transportation becomes more expensive. That affects supply chains across multiple industries. Food production, retail distribution, and global shipping all depend on fuel. Central banks are especially sensitive to these developments. If inflation rises too quickly, central banks may be forced to adjust interest rates. Higher interest rates can slow economic growth, and slower growth can ripple across global markets. This is why geopolitical crises often have economic consequences far beyond the battlefield. A conflict in one region can affect energy prices worldwide, and energy prices influence nearly every sector of the global economy. Meanwhile, governments are monitoring the situation carefully. Energy security has become a top priority for many countries. Strategic petroleum reserves may be considered as a way to stabilize markets. Some countries may increase domestic production. Others may attempt to diversify energy supply chains, but these solutions take time. In the short term, markets respond primarily to risk perception. And right now, the perception of risk in the Middle East is high. Military movements, political statements, and diplomatic negotiations are all influencing market expectations. Energy analysts say the next phase of the crisis will depend heavily on whether tensions escalate further. If the conflict expands, energy infrastructure could become a target. Pipelines, export terminals, and refineries could face increased risk. Even temporary disruptions could push prices significantly higher. On the other hand, if diplomatic efforts succeed in reducing tensions, markets could stabilize relatively quickly. Energy traders closely monitor signals from governments and military forces. Announcements of negotiations or ceasefires can calm markets, but threats of escalation can have the opposite effect. Right now, the global economy finds itself in a delicate position. Energy markets remain volatile. Stock markets are reacting cautiously. Inflation concerns are rising again in several countries, and geopolitical tensions continue to evolve. Economists warn that prolonged instability in the Middle East could have lasting effects on global growth. Higher energy costs can slow economic recovery in many regions. Developing countries are often particularly vulnerable to rising fuel prices. Their economies depend heavily on imported energy. For them, even moderate price increases can create serious financial strain. Meanwhile, energy producers may see temporary economic benefits from higher prices, but those benefits often come with increased geopolitical risk. In other words, instability rarely produces long-term winners. Instead, it creates uncertainty that affects the entire global system. As markets continue to react to war tensions, the coming weeks will be critical. Investors, governments, and energy companies are all watching closely. Because the trajectory of oil prices could influence the direction of the global economy for months to come. If tensions ease, markets may stabilize, but if the conflict deepens, the world could face a new period of economic turbulence driven by energy shocks. For now, one thing is clear. The connection between geopolitics and energy markets remains as powerful as ever. And when war threatens the stability of major oil-producing regions, the entire world feels the impact.